Have you ever felt like the stock market is this super complicated club you're not invited to? Well, today, we're going to tear down the velvet rope. We're going to break down what a stock actually is, and we'll do it with a simple story that I promise you will not forget. So, it all kicks off with this one question. What in the world could a slice of pizza have in common with a share of a massive company like Apple? I know it sounds a little weird, but stick with me because by the end of this, it is going to make perfect sense. This one idea is the key to everything. All right, but before we get to the pizza, we need to get on the same page with three key terms. Just think of them as the basic building blocks. Don't worry, we'll make this quick. First up, a stock. You'll also hear it called a share. They're the exact same thing. And it's pretty simple. It is a single, tiny piece of ownership in a company. So when you buy a stock, you're not just getting a number on a screen. You are literally buying a small part of that business. You've become a part owner. And that leads us right to our next word, shareholder. It sounds fancy, but it's really just the official name for someone who owns a stock. As a shareholder, you get a claim to a slice of that company's profits. So where does all this happen? Where are these pieces of companies bought and sold? Well, that's what a stock exchange is for, like the New York Stock Exchange or the NASDAQ. The easiest way to think about it is like a giant, organized marketplace where investors trade these shares back and forth all day long. Okay, now for the fun part. Let's make this real with a story. Everybody, meet Sarah. She is an amazing chef, and she has a dream of opening her own gourmet pizza shop. The recipe is perfect, but she needs some cash to get it off the ground. So to make her dream a reality, get a location, buy the big ovens, hire a team, Sarah does the math and figures out she needs $100,000. The good news is she's already saved up half of that, so she has $50,000 ready to go, but she's still 50 grand short. So how is she going to get that other 50,000? Well, instead of getting a loan, she decides to sell off pieces of her company. She needs to raise half the money, so she decides to sell half the business, 50%. To do that, she splits that 50% into 5 equal shares. So do the math. Each share is worth 10% of her entire pizzeria. And to get that 50 grand, she puts a price tag of $10,000 on each of those 5 shares. Now, let's bring in Alex. Alex is an investor, and he absolutely loves Sarah's business plan. He just knows her pizza is going to be a smash hit. So he pulls the trigger and buys 1 share for $10,000. And boom, just like that, Alex is a shareholder. He now owns 10% of Sarah's pizzeria. His 10 grand plus the money from 4 other investors gives Sarah the $100,000 she needs to open up. And this is the key. Alex's investment helped make the business happen, and now his financial success is completely tied to the pizzeria's success. Okay, let's hit the fast forward button. 5 years have gone by. Sarah's pizzeria is open and running. But how did Alex's $10,000 bet turn out? Well, like with any business, there are really 2 main possibilities. Things could go great, or, not so great. Let's take a look at both. This slide really lays out the risk and the reward perfectly. So in the profit scenario on the left, the pizzeria is a total hit. It's now valued at $300,000. Alex's 10% slice is now worth $30,000. That's a huge win. But look at the loss scenario on the right. The business struggled, and now it's only worth $80,000. Suddenly, Alex's 10% share is only worth $8,000, meaning he lost money. This shows you the fundamental idea of owning a stock. Your fortune rises and falls right along with the company's. So that brings us to the big question, right? When you see there's a real risk of losing money, why do people like Alex invest in Sarah's Pizzeria, or in Apple, or in any company at all? Well, it really comes down to 2 main ways an investor can make money. The first one, and the one most people think of, is called capital gains. That's exactly what we saw in our profit scenario. You buy your slice of pizza for 10 grand and hope the whole pizza gets way more valuable so you can sell your slice later for 30 grand. Simple. The second way is through dividends. This happens when a company's doing really well and decides to share some of the profits directly with its owners, the shareholders. It's kind of like Sarah giving Alex a little cash bonus every few months just for being an owner. Okay, so now you get it. You know what a stock is, how it works, and why people invest. If this has sparked your curiosity and you want to learn more, let's wrap up with just a few classic foundational rules for anyone who's just starting out on this journey. First off, research. I mean, it's just common sense, right? Never put your money into a business you don't really understand. Second, a great place to start your learning is with companies you already know and use every day. And finally, diversification. You've heard the old saying, don't put all your eggs in one basket. It's so true here. Spreading your investments out is one of the most important ways to manage your risk.
So there you have it. A stock is really just a slice of a company, kind of like a slice of pizza. Now that you get the basic idea, you might start looking at all the businesses around you a little differently. Which leads me to one last question, just for you. What company would you want to own a piece of?